We're good.
Where's Hawaii?
Oh yeah, we do have some people in Hawaii.
Morning, so,
I wish I was back in Hawaii.
Why, leave the complex stuff for me, Ben.
I wish I was back in Hawaii some days, man. But hey, thanks for tuning in, everybody. Once again, Money Mondays here from the Disrupt TV studios, Houston, Texas. You got your friends Ferris and Ben here from Disrupt Equity.
Yeah, so welcome everybody. So for those of you tuning in for the first time, Money Mondays, 3:30 Central every week on Mondays, and we talk about different topics. You guys are more than welcome to suggest topic titles. We will entertain them. Actually, this was a topic that someone has suggested, so we're happy to kind of do suggestions. But at the end of this, we will do Q&A. You can ask anything you want. And today's episode is what, Ben?
About syndication deal structures, right?
So
you know, how to put deals together.
Syndication, Ben, for those that don't know.
Yep, that's actually probably a good place to start.
Maybe then from there we can talk about the structures, right?
All right, so syndication is essentially a way that you're structuring a deal where you're pulling everybody's money together, right, as the down payment. But in order to do that, right, you're forming an LLC, and as the general partners or the managing partners of the deal, me and Ferris would then sell shares to investors, right? And that share is worth a certain amount of money. Let's just call it $1,000, right? So if you put $50,000 in, I'm selling you 50 shares of that LLC, right? So I'm going to pool all of those investors together, right? And I'm going to use that as our down payment and our working capital for the deal, right? So now they are the LP partners of the deal, and we're the GP partners of the deal, right? You can call them managers and members. There's a couple different ways you can do it. But, you know, a lot of people know the LP GP structure, so that's kind of what we're going to describe it as today. So, you know, that's kind of what a syndication is in a very, very simplistic way, you know, that you're pulling people's money together in order to buy bigger assets, right? Mm-hmm. You know, because, you know, when you tack on a couple zeros to some of these syndication deals, some of these big multifamily properties that we buy and some other commercial assets, you're going to quickly run out of money, even the most wealthy of people, right? So it's always better to kind of leverage everybody else's time, money, you know, and you know, experience.
It's, you know, pulling everyone together, you guys go do something bigger, harder, better together.
Yep, absolutely, absolutely. So all right, so let's get right into it. So what do we got? We got multifamily syndication deal structures. So let's talk about kind of the most common ones that we kind of see, right? You know, in our world. Now you can structure a deal. Let's caveat this. You can structure a deal 1,000 different ways. As long as it's legal, right? As long as this person is all right with the deal structure and you're all right with the deal structure, you can put a deal together, right? So we have friends in the business that structure their deals a lot differently than we do. And kudos to them, right? You know, we have a little bit more, I guess, run-of-the-mill way that we structure ours. You know, so maybe I'll start off with the way that we do ours. So, and I'll get into preferred returns, so just bear with me here, folks. We have an 8% preferred return, right, which we'll talk about here in a minute. And then after that, we have a 75-25 split. 75 going to our LP investors, 25 going to the managers, right? And remember, that's after the 8% preferred return, right? So that's kind of our vanilla way. We feel like that's the best of both worlds.
But just so people understand, right, structures can be anything you want.
Yes, that's what I'm saying.
It could be a 10-90, it could be a 90-10. It's ultimately about you and your equity group and what they're looking for and what you can perform on, and is there kind of a happy ground, right?
Yeah, it's a negotiation.
Yeah, it's really a negotiation. Obviously, the different ways to structure result in more or less money for the operators and more or less money for the LPs.
Yep.
So something to keep in mind. But like Ben said, kind of the industry norm right now is 7 or 8 prefs, right? And then from there, you know, I've seen everything from 50-50 all the way up to 80-20 splits, right?
Yep.
So what does a preferred return do, Ben? For those that don't understand, we keep talking about a pref, right? And again, some people don't have prefs at all, right? So, but kind of in the pref world, I think that's really what's becoming more and more popular, right? What is a preferred return, Ben?
And I think a pref was really, that's really what you're probably going to hear, but I guess the longer phrase of that is preferred return, right? They're synonymous. So a preferred return or a pref, right, is essentially it's a percentage that is paid on the amount of money that you've raised. Right? So let's use whole numbers, right? Let's say we've raised $1 million and our preferred return is 8%, right? What's 8% of $1 million, right? 80,000, right? That is what is owed to investors.
Ben looked me straight in the eye and he's like, I got that right? So
hey, I can get some of that math correct, right? You know, I'd had to practice that one before this one, so that's just, you know, I'll caveat it with that. So anyway, so we're paying 80,000 out, right? That's the first 80,000 that goes out. It goes to our investors as the preferred return. Now, let's say that you've made 100,000 total, right, in terms of cash flow. That 20,000 is now split 75-25 with your investors.
Yeah, and maybe just to simplify it a little bit, right? All it means is that investors get an 8% annualized return on their money first,
Yes.
and anything after that is being split with the sponsors.
Yep.
Right, so it's a way to make sure that the investors eat first before the sponsors eat, right? And you need to make sure you're getting deals that can support that. So that's what the preferred return model is, and it kind of helps make things, a little bit more investor friendly, right? Because again, if the deal doesn't make enough money to pay that pref, well, you as a sponsor are getting nothing on the upside.
Yeah.
And so, again, there's a lot of ways to structure the preferred return. So make sure between compounding, between accruing, all of that. So make sure you read a company agreement. We're not lawyers. We're not CPAs. We're not any of that stuff.
And one thing to mention, at least the way that we've structured it, right, is that money is still owed, right? So, we do a lot of value add plays. We do a lot of repositioning. Sometimes that stuff takes time, right? 12, 18, 24 months, right? So if you're not able to hit that preferred return, which is what it's called in the industry, right, that money is still owed to investors. So you usually have a catch-up period where you try to catch up on the pref, or even if you go all the way to a refi or you go all the way to, say, a sale, right? That money that wasn't paid as part of that preferred return is still owed to your investors before we get dime one. So I always like to kind of let people know that, because it's kind of a little bit different, way of structuring it. Preferred returns is something that we introduced probably about 6 or 7 deals ago. We've both done some more vanilla 80-20 splits and some other things too. So, obviously want, folks to know that you can do it 1,000 different ways. But once we kind of started opening up our investor list to people kind of outside Texas, their expectation was that there was a preferred return included in that, right? Yep. So let's talk about other deal structures, right?
Yeah, so maybe the next one, right? So you can do the pref or without the pref, right?
Yep.
So those are the most common, 60-40 with an 8 pref, 75-25 with no preferred return, right? The next common way really is kind of what we call a waterfall, right? You hear that a lot. It's more popular, I guess, on the kind of the private equity institutional world. But really what it means is that you are making your money in tranches. So it's really the scenario. We had a deal that home run, right? Our investors made a ton of money. We did well, but we didn't get to milk all that upside, right? Had we had a waterfall, what it means is that investors get up to a certain return, right? The splits is more favored towards them up until a certain return. Then that waterfall hits, right? If you kind of think about a waterfall, right? There's different legs, different tranches. Well, once they hit that return, now after that, the upside is more in our favor, right? So it really motivates the sponsor to get those home runs, because if you hit that home run, right, you're getting a lot more money on that upside versus keeping it 75-25. So to give you an example, it might be a 75-25 split until you hit an 18% IRR.
Yep.
Then after 18% IRR, it might be 50-50%, right?
Yep.
Where
or it could be anything, right?
remaining.
Once again, folks, you don't overthink it, right? You have to determine what your investor, your equity pool is willing to accept, right? And what they think is a good deal. Right? Because like I said, we're friends with people that their deals are completely different than ours, but guess what? Their investors are happy, right? So beyond the waterfall, another way that we've seen it is almost structured almost like debt, right? So, it's not really debt because you're obviously still taking out a loan, right? But it's kind of structured that way. Whereas the investors are investing in money and then they get a straight, say, preferred return. Maybe it's 10%. Let's just keep it straight simple. They get none of the upside. Right? But they get their preferred return. They still get the tax benefits of investing in commercial real estate. They get all the other benefits, right? But they don't get the upside. And we've also seen deals where there's been different classes, right? Where you can have maybe that's one class, and then you have maybe, somebody that has a less of a preferred return, but then they have, some of the upside. And I think, those are starting to kind of become more and more popular. We've been seeing those lately. And, I kind of actually like it, right? Because all of our investors are investing for different reasons, and they have different timelines, right? Yep. Some investors of ours are very, very patient. Some are, hey, this is my retirement. This is what I live on, right? And so they have to take that into consideration when they're looking at each deal. But if you give them both options, right, they might be more likely to invest in your deal too. So, as long as it's legal and your investors are cool with it and you can structure it that way, I say go for it, right? So that's just some of the deal structures we've seen.
Yeah, so maybe to pause for a little bit, just kind of go through some of the Q&As. If anyone has any, or not Q&A, but sorry, go through some of the comments. If anyone has any comments or questions, go ahead and leave them. We will answer them live. So first one, Ronnie says, "What's up, guys? Plaid Mondays." And of course, we're waiting for that one.
I literally was in my closet this morning. I was like, I'm gonna wear one.
Yeah, and I did wear a plaid shirt. So
I did this for you, buddy.
Ronnie says preferred equity. Yep.
Yeah.
Preferred equity.
Yeah, absolutely. We'll get into that here in a minute.
Yeah. Chris Collins basically says, "Oh, what's up, guys?
What's
Oh,
up, buddy?
Chris,
What's up, man?
Long
You're still you got to fly into Houston, man. We owe you some tacos. All right, buddy. It's been a while.
Says, I've seen 3 classes in one deal. A1 is preferred equity, A2 common equity, A3 fund of funds.
Yeah.
All right. Well, we're not gonna go through all that because I think it's gonna complicate most viewers, right? But to the point, right? There is another. So there's preferred returns. There's preferred equity, right? Which is almost I like to consider basically like another loan, right?
Yeah,
where there's a different group of people getting money first, and the investors are after that. We don't like that structure so much to date, because essentially you are ensuring you pay someone else a complete return before you're paying your investors anything. So
it seems
a big potential that investors don't make anything, and it's just very, you have to be careful.
You see that more on probably bigger deals too, maybe. I mean, we've been hit up by those preferred equity shops. I'm not as big of a fan, and either is Ferris of that type of structure, but you can certainly do it that way. It calls mezzanine, right? Second note, right? All that stuff is essentially all the same thing as preferred return or preferred equity, excuse me. It's another way of structuring it. That's a good point.
So Chris says, Ferris, your mic is super low volume. I'll have to look at that. Chris, you should come down to Houston and help us fix our studio. I know you're an expert in
dude, what's going on,
stuff,
dude?
So,
Mr. Hollywood over there, man.
Well, see, but he says that in the multiple classes, does the preferred return versus the straight % return get put lower down on the totem pole for being paid? My worry is, I get paid less. Yes, actually, Chris, usually it does, and that's actually my problem with some of these, the different classes, right? Yeah. A lot of times, some of the classes are structured almost like debt, right? And so it's something to keep in mind, because a lot of times, those investors are going to get their return first, then anything left over, the deal might underwrite like it's going to give a big return. But I don't like it because you're the third person getting fed, and that's the problem, right? If food runs out, you're getting nothing. So that's something to keep in mind. And I think, I caveat that with just read the operating agreement, because, there's absolutely no reason why someone couldn't structure it that way, right? And structure it differently. So and keep that in mind on that part.
There's definitely a potential for that, right? But then there's, ultimately every deal is different, and that same structure might work on another deal too, right? But something to kind of keep in mind, right? And understanding how the numbers flow, right? A lot of people might sign up for something and they don't quite 100% understand it. You gotta read that PPM and that company agreement. You gotta ask questions, and you have to underwrite these deals on your own, folks.
Yeah, and if you don't read anything, spend the 2 minutes it takes to read the section that talks about distributions, read the section that talks about a sell.
Yep.
If you don't read anything, at least read those 2 things.
Yes.
So those will help you understand what the structure is, right? Is it compounding? Is it not? Is it accruing? Is it not, right? There's deals that the pref does not accrue. So as a sponsor, if it doesn't pay out, so what?
Doesn't hit.
So there's things to kind of keep in mind.
And that's not how we do ours. Like I said, ours rolls over, right? And so that's what I was talking about earlier, right? If it goes all the way to sale and we owe, say 4 points from that year one, right? Those 4 points get paid out first. So, something to kind of keep in mind.
So Chris asks, what question can I be asking the sponsor to really clarify, when do I get paid? I think it's exactly, I'm glad you're bringing this up, because this is something that I'm seeing it's more popular and it's been rubbing me a little bit, right? So I'm glad we're at least talking about it. But, ask the sponsor, what is the order of payments, right? What happens if you only have enough to pay tranche number 1, tranche number 2? Does tranche 3 get anything, right? Because again, you have to really look at that, because, let's just give you an extreme example, right? Let's say tranche number 2, you're raising $5 million. Tranche number 1, you're raising $100,000. Tranche number 3, you're raising $100,000. That's not a lot of money for tranche number 3, right? But you have to be able to pay that, the pref on that $3 million or the $4 million before you get to $1 on tranche number 3. There's a very, very almost extremely high possibility that tranche number 3 never gets anything, right?
Wow.
And so you have to really look at that, and I think it's really understanding the order of payments, and it really goes back to what I said. Read that section about the preferred return, which classes are getting paid, and then understanding, hey, and I think, Chris, maybe the simplest way to ask them is say, hey, let's say your NOI, your actual distributable cash in 1 year is half what they said it is. Ask them who gets paid what. That's probably the easiest way to do it, right? Because then you can understand, okay, tranche number 1 they're probably getting whole. Tranche number 2, they're probably not going to get everything they wanted. And then you can see, is tranche 3 going to get anything, right? Is it shared? Are they sharing the risk? Or essentially is tranche number 3, usually, and this is what I see, tranche number 3 is signing up for more risk with the potential of more return. But I think people don't really realize how much more risk that is.
Yeah, and I think, folks, you have to realize what is being projected. They're projections, right? These are not guarantees. Things happen. especially on kind of value add, 30, 40-year-old assets, you're gonna, so that was actually a good example, right? If half of what you're talking about is true, right? Is anybody who's gonna get paid?
Yeah.
Right. And I think that you have to ask those tough questions. And I always tell people too, right? You need to be prepared to underwrite the deal on your own too, and see if you can back into the numbers that the sponsors are. People ask us, hey, can I have the T12 and rent roll? And they ask us all kind of, like they're gonna offend me or something.
Yeah.
That's fine. We're an open book. You guys underwrite it. If it doesn't work for you, it doesn't work for you, right? And so you need to be prepared to see if you can get to those numbers on your own too, right? So that's something to kind of keep into consideration.
Yeah.
So preferred returns, we kind of talked about what those are, right? So let's talk about fees, right? And I don't think that we call this kind of fees in multifamily, but we've seen this as fees in commercial real estate across the board, right?
Yeah.
Some of the more common runs, let's just go from most common I've seen in pretty much every deal, asset management fee. What's an asset management fee, man?
Asset management. So asset management fee is basically a fee that is being taken for running the day-to-day, right? The property manager is doing the on-site day-to-day, but there's kind of the back office representing the ownership group as a whole. So that's what the asset management fee. Industry norms is kind of that 1.5% to 2% is what we've seen, right? But really, it's again to Ben's point, it's important to understand all the fees because we see deals. Again, we consider ourselves very simple fee structure, fee light in a lot of ways. We've had people tell us we should be increasing our fee, right? It's important to understand not just the structure, but also the fees. And is the sponsor motivated to make the deal actually perform, or are they just making a lot of fees and they're just piecing it out, right?
Yeah.
And so common fees, right? Acquisition fee is a good one. That one's usually 1% to 2%. It's kind of the norm.
But 1% to 2% of what, though, right?
The purchase price.
All right, and so, but you
Actually,
can...
back to asset management, to your point. It's 1.5% to 2% of collections.
Yes, total collections for the month,
each
right?
month.
So if you collect $100,000, we're taking 1.5, we're taking $1,500, right? So people need to understand how that works, right?
Yeah.
So that's the most common, because we've seen that pretty much across the board, right? Regardless if you have a pref or not, it doesn't really matter. Everybody's always usually taking an asset management fee, right? Acquisition fee is probably second most common that we've seen in the industry, and like Ferris said, it's usually 1% to 2%. We've seen it smaller than that. We've seen it significantly higher than that.
There are some guys that make more on one deal than we make on three, and that's okay.
It's all right. It's all right. Now we take it off of the purchase price. People also have taken it off of the equity that they raise.
So there's different things.
There's different ways. So you need to ask that, and we every single webinar that we've ever done, we always get asked that same question. So you need to ask your sponsor that, right? Are you taking that off of the equity raised, or are you taking that off the purchase price, right? Because then you'll be able to determine what that acquisition fee is. Disposition fee.
Yeah, disposition fee is a fee for selling the property.
Yep.
Right.
Yep.
It's a lot of work to put together a sell. I was on the phone today with a broker on a deal we're selling right now.
Yep.
We don't take a disposition fee today, right? But again, a lot of people do, and so understanding that, because again, if you're getting nickel and dimed every step of the way, someone's making a lot of money, and at least as investors being, are they being made whole or not?
Yeah.
And again, disposition fee usually 1%.
Yeah, 1% to 2%. Once again, it's similar in ways to the acquisition fee, right?
Yeah.
One on the buy, one's on the sale, right?
And then keep going through.
We got a refinance fee.
Yeah, I've heard of a refinance fee as well. So similar, kind of like a disposition. We're doing a refinance right now. It's a lot of work.
Yeah, and we're not taking a fee. We don't take the refinance
Yeah, we
fee.
don't.
In fact, the only two fees that we take is acquisition and asset management. So
Yeah.
all these other fees are just fees that we've heard of, folks, that people take.
And asset management.
Well, no, I said asset management.
sorry.
Acquisition. But it does not mean if they take fees that it's not a bad deal.
Yeah.
I'm just putting that out there that we don't take them. So
Continue on construction management fee.
a construction
That's one we
management fee?
haven't taken. Honestly, as an operator, we probably should be taking them because it's just
That's
a lot
a
of work.
ton of
Depending on the
work.
deal, we've done deals that are deep value add, brought the deal down to 40% occupancy, brought it back up to 95%. There's a lot of work that went into that, a lot of headache, a lot of stress. And, again, we can buy that deal and make a lot of money for our investors, or we can buy a simple deal that's a lot less work for us. And so it helps kind of share that workload, that burden, that effort.
Yeah. I mean, that's, that takes a lot of time from not only managing the contractors, but, doing the draws, and just making sure that you're coming in under budget or on budget and dealing with the lenders. They have a lot of requirements, a lot of paperwork on their side. That all takes time, folks. So I'd say the first year or two as a GP or as a sponsor, if you've got a value add play, that's going to be where a majority of your time is going to be spent.
Yep. And then let's see, what else is there? What other fees are we missing?
I've seen KP or
Ronnie mentioned
guarantor.
there's a loan guarantor fee.
Yeah, that's a loan guarantor fee, right? So if you sign on the loan as the loan guarantor, right? You
I've
might get something.
heard of broker fees. That's the one we've seen. All right, where people pay essentially an in-house broker or another broker.
Yeah, gotcha. Yeah.
So that's another one, which again, I mean, like, how's that different than acquisition fee? So, understand
we've
the fees
seen like
that you're
all 6 of those on one deal too,
yeah,
right?
we've seen them all. So, and it's not that there's good and bad, but something to keep in mind.
Well, that one was bad, but that was because of
So let's go through some Money Mondays. We do this Monday every Monday, 3:30 Central. We talk about a bunch of different topics. If you have ideas for future topics, let us know. We're happy to go through them.
Yeah.
But at the end, and which is right now, we're going to go through Q&A. So if you have Q&A, go ahead and list it. We'll go through questions. To me, this is the best part. It's the most fun part for us, I think. So kind of going through. So Chris says that's a great response. If there's a lower return 1 year than you're projecting, that will really show how it works. And yeah, Chris, like I would just say, I would be blunt, half the return. What happens?
It happens too, right? With these value add and repositionings, people right out the gate thinking they're going to get money month one. It just doesn't work like that. It just mathematically doesn't work. So you just have to ask those tough questions.
Yeah.
So we did get a question ahead of time, right? Any warning signs passive investors should look out for with certain deal structures? We kind of talked about this before. I wouldn't say that there's warning signs. I would say that you just need to be comfortable with the deal structure, just like what Chris was kind of asking about. You need to understand how it works, right? And then you have to say, is that in line with my risk profile and what I want to make out of a deal, right?
That's one thing, but to me the warning sign is purely if the deal doesn't perform, did the sponsor just make a ton of money, right? That's ultimately, I want the sponsor motivated to make sure the deal performs, hits his metrics, and then I'm happy for them to make money, right?
Yeah.
And so to me, it's, is it the deal that, because you can position any deal like it's going to look great.
Yeah.
And so it's really, are they making a ton of money up front, or are they actually motivated to hit those metrics, hit those hurdles, whatever you want to call it? So that's what I would call my, warning sign.
Yeah, you have to look at that. And then, ultimately if there are a bunch of tranches before it gets to where you're investing to, like with the pref equity and some of these other real creative structures, be careful, right? It could be, you could step into a situation where you do get essentially nuked. Like on a pref equity deal, folks, what they don't really tell you is that essentially if there's no more money and as long as you paid your pref equity off, everybody gets nuked out.
Yep.
So you have to be very, very careful on those deals.
Yeah.
So I would say that's probably the biggest warning sign. But everything else, you just have to say, hey, I'm fine with them taking a fee, or I'm fine with the structure. Let's go for it, right?
Yeah, absolutely. So continuing on, we've seen loan guarantor fees. So we talked about those.
Yep.
Chris says, your Monday lives bring so much value, guys. Keep them up.
Thanks,
Thank
buddy.
you, Chris. We appreciate it.
Yeah,
Always
man, we need
happy
that
to do
type of
these.
feedback, buddy. Yeah, this, we think through this stuff. We're trying to educate folks because we want people to do the business the right way.
Ronnie says, what about a guru fee? We haven't taken those, but,
No.
we're gurus.
We're absolutely not. Everybody that knows me knows that I'm anti that. And in fact, those people should be given some money back.
Yeah. So let's see. Ronnie says, for new construction, I've seen development and construction fees. Yeah, absolutely.
Yeah.
Right. And the developer has to get paid some way. It's a
developer
2-year
fee.
project. So.
Yeah, it's a developer fee. Is essentially what it's called.
Yeah. So continuing on, Chris says, so all these fees are baked into the return for investors, but are there any that investors should run from? To me, disposition fee, because it can incentivize a sale even if returns to investors are light. Yeah, disposition is an interesting one, but also to Ben's point, we talked about the refi fee, right? So you should understand one thing that we didn't really talk about, we kind of glossed over, is what is considered a return of capital versus return on capital, right?
Yep.
And so previously we've made the mistake where we did a refi and the sponsors didn't get any of that upside because we didn't pay down the capital. And so really in that model as a sponsor, you're not motivated, the interests aren't aligned. And so I look at deals as, is a sponsor motivated or are the interests aligned for a refi and a sell, all right? Yes, there's a disposition fee, but also if there's a refi fee, they're just as motivated, right? So, now you got to make sure that they're not getting one, not the other, or vice versa. But something to think about. It's about keeping interest aligned to where no matter what you do, right? And as a sponsor operator, right, it's your fiduciary duty to get returns for investors. That's first and foremost. But then from there, you want to make sure that whenever sponsors make money, there's a clear incentive around making sure the investors are getting compensated accordingly.
And I'm going to take the contrarian argument that the dispo fee, the disposition fee, might actually incentivize somebody to increase the value, right?
Yeah.
Above and beyond where it might be because they're going to get paid at the sale too, right? Everybody could say, any one of these fees can kind of be picked apart, right? That's why I always go back to, as an LP or as an investor, do you feel comfortable with the business plan, with the deal, with the submarket, and the sponsorship team? If so, and the one thing that I wanted to point out, right, is that we have seen deals and we have seen decks from sponsors that are showing gross numbers. They are not
actually. Ben brought up a good point.
Like,
one thing to understand is, are the numbers you're looking at gross, meaning the entirety of the investment, or is that returns to investors? Because those are very different things, right? Let's just pick a simple example. Let's say you have a 50-50 split, no pref, right? Well, maybe that deal is going to make $1 million year one. Okay, great. Let's say you raise $5 million, so you get a 20% return. But really now, if that's 50-50, the investors only got $500,000, so they're getting 10%, not the 20% they thought. So that's this little thing to kind of keep in mind. Yeah,
you'll see the stuff, folks, just to look out. Project level IRR versus investor level, right? You have to be very careful. I've seen that type of creative, ways of structuring their decks and kind of positioning stuff, and that's ultimately not great.
So let's keep going. So for those of you tuning in, Money Mondays, we do this every Monday, 3:30 Central. Typically go for just about 30 minutes, talking about a bunch of different topics. This week we're talking about multifamily deal structures and fees. And if you have questions, feel free to leave them. We're going through the Q&A right now. If you have ideas for future topics, let us know. But the Q&A is the best part. It's the most fun part. We can kind of learn together with everybody else.
And one thing I wanted to point out real quick, the deals that you're going to see from us, folks, is all going to be net, right? So any fee that we would take, whether it be acquisition or asset management fee, everything that's presented to investors.
And I would hope most sponsors do that.
I know, but they don't, like we said earlier. So I just want you to know that the ones that you would see from us are going to be net to investors.
So keeping going down, so we're going to run short on time. Isaac says, what can an investor look out for when it comes to return of versus return on capital? Right, look at the company agreement, look at the PPM. It really talks about basically a distribution. Is that paying down the investor capital stack, right, or not? That's really what you're looking in for, right? You're trying to understand what that capital account looks like and when is that being reduced. Because some people also on distributions are paying it down. And so we've had an investor try to argue with us about the splits, and he said, oh, you guys are taking a lot. And he's showing another deal. And then I kind of, after we dug in with them, we realized, well, yeah, your deal is basically paying down, and so the sponsor is going to always get that 25% regardless of the pref, because each year you're paying down the investment, and so they owe less. So to give you guys an example, let's say I invested $100,000, I got $10,000 year one. So now year one, I'm owed 8% of $100,000, so I'm owed $8,000. So now that $8,000 came, it paid down. You could have paid down my investment $10,000 or $8,000 depending on the language. But now year two, I have $90,000 or $92,000. So now I'm owed 8% of that, and it basically, for the investor, over time, my investment capital drops, right? So something to keep in mind. And again, there's not good and bad, but understand them because there are nuances that make a big difference.
Yeah, and have your lawyer or your CPA kind of walk you through this, folks, if you don't fully understand that.
Yeah, so
because it can get very, very complicated. The one thing that I wanted to point out is on a refinance, the way that we structure it, right, is so say we've raised $1 million, and let's just keep it simple, we get $1 million out, right? On a refinance. That's going to essentially give everybody their money back. So now the preferred return is no longer, right? Why is that? It's because you no longer have any money in the deal, right? The preferred return is always paid on the money that's still in the deal. Now let's say we only made $800,000, right? Now our preferred return is paid on that $200K that is left in the deal.
That's how we structure it, because again, it goes back to what Chris said earlier, aligning interest with a refi and a sell, right? So something to keep in mind. So keep going. So John Montero says, nicely lined up on screen, gents. Thank you, John. We got to have you come down here and, I tried to line up my head right here. I told Ben not to keep swaying, but he has to. Gotta have you come down here, John. We could do an episode with you.
Yeah, man, come on.
Let's see. Miles Wallace says, new to group. Good afternoon, everyone. Welcome, Miles.
Thanks, buddy.
Glad you're here. Chris Collins says, what Isaac said, great question. As returns come in, does it lower investor equity, et cetera? So maybe and then say return of capital versus return on capital. So again, just to rehash it, the things you want to look for is, does distributions, does that pay down the capital stack or not? Does a refi pay down the capital stack or not? Those are probably the two biggest ones to kind of keep in mind. I'm trying to think if there's any sneaky stuff that I've seen.
Yeah, I think that's probably the major two, if not the only two.
Yeah, so let's see. So Ernest Harbin, how's it going, Ernest? Long time no see. I was actually just thinking the other day, I hadn't heard from you in a while. Yeah. He says, I'm feeling very learned. Glad if we can learn you, then I'll take it. Ronnie says, what people don't realize is GPs make the most money at the end after investors get paid at the sale. Ronnie, I agree, but I also disagree. It depends on the structure, right? Some guys make their money on the front end and they're just trying to buy as much as they can really quickly, right?
No.
Ernest says, fees and Bs are both part of life. If the LP is getting paid with a GP at that point, it just becomes the label. Totally agree, Ernest. It's basically it's just making sure that that the LPs are getting paid.
Yeah.
So people should not care if the GPs are making money if the LPs are making money, right?
Yeah, it's kind of how I look at it, folks. I mean, people are like, oh, there's a fee in there, and this other deal doesn't have a fee. Well, I mean, if our deal is making just as much, if not more, does it matter, right? I mean, you have to kind of think of it like that, right? Because there is this one thing that I always kind of tell people, especially new investors, there is a significant amount of work that we have to do into these deals. We live and breathe this stuff every single day, every single week. Right, so don't think for a second that we're just buying a deal and coasting through it to the sale. It doesn't work like that,
Yeah, so let's keep going. So Isaiah, I apologize if I mispronounced it. I think it's Isaiah. Thanks, guys, for valuable information. What's up, Ben? You didn't ask me for what's up, so I'm gonna let that slide this time. But
hey,
he says what's up. Ernest says exactly. Ronnie says deal level IRR is a term I've seen for passive investors. Always ask for net returns. Completely agree.
Yep,
so that means ask for the returns that your dollar is going to get you, not
what the project's
going to get.
Yeah.
Rob asks, as a potential investor, is there a common model that allows investors to have more participation in the upside at the end? And then Ernest kind of went ahead and answered. Said yes, that's what equity waterfall comes into play. Well, actually, it's the opposite. The waterfall lets the sponsors make more on the upside, I would say, right? Rob, so to your question, if you want the investors... It could be what we talked
about earlier, right?
It could be just a straight split, right? You're getting a straight split. Like we had a deal that we sold that was just a straight split, and our investors did really well on that deal. Like I said, had we done a waterfall, we could have milked more of that upside. And so things that make it more investor-friendly, it's better splits. Preferred returns always help the investors, assuming the splits stay the same, right? Mm-hmm. And, understanding the waterfall. I mean, I guess I have heard of a waterfall going the other direction.
You can.
Right, and I guess, maybe on a development, maybe that's the argument, right? Where it actually becomes more investor friendly over time. So maybe Ernest, you're right. But yeah, so something to think about. So Chris Collins says GP fees are earned for sure.
They are. Yeah. Thanks, buddy. Yeah, a lot of people don't realize this. This is a lot of work, guys. Gals.
Yeah, it's been more than a year since we bought our last deal, and trust me, we've done a lot of work on deals since then. So
yep. You got to.
We're trying to find the right deal, so hopefully soon. So Money Mondays for those of you tuning in
first time. We got a lot of participation on this one. All right.
We like the participation. The Q&A is the fun part.
We want
and I think it helps everyone else learn something. So
yeah, we want it to be interactive. We love the Q&A. We love the comments. Let us know if there's topics that you want to talk about. We don't have to talk about multifamily. We love anything real estate, anything being an entrepreneur, business processes, technology. Let us know what we can talk
Seriously,
about.
Seriously, guys. Anytime you guys can let Ben talk, he's happy, guys. So, we're happy to talk about stuff.
Starbucks here too. So,
hey, where's my Starbucks, Ben?
Hey,
where's
man, I
my
Starbucks
yours
too.
Man.
So, sorry, buddy. You snooze, you lose.
This guy. But no, for those of you tuning in, Money Mondays, every Monday, 3:30 Central. We typically try to do it for 30 minutes. We're already over. And we're just going through Q&A, so people have questions, feel free to ask, and we'll leave it open another minute or two. I know we got a lot of questions today, so let's see. So we have another question. How has in-house property management changed to advance your business? What about investor returns? Yeah, it's made a big difference. Yeah. I mean, we, some deals that we took over just, challenged, right? I mean, trying to get everything resituated, cleaned up, and it's funny looking at our charts, and our charts are literally like this. And so our expenses have dropped significantly.
Yeah, I would say that it's, every property management company can drive revenue, right? For the most part. But what they do a really poor job of is expense control. And I think we have been buttoning that up over the last 8 months. Probably better than anybody in the industry.
Yeah, and it just really...
But it takes time. These deals just take time. It's like moving a gigantic boat out of the way of a glacier, right? It's not going to just be like, let's just turn the wheel real quick and just move
I was just talking to Ben. One of our deals that was kind of just having all sorts of drama 6 months ago, we're feeling really good about it now. So, it's made a big difference, and we're doing third party now too, and so that's helping us continue to build out all the systems, and just scaling up and rethinking that business. How do you give a level of transparency, visibility that no one's ever given or seen? And so, I mean, our expenses have dropped significantly, and just accountability right across the board. I mean, we're just,
now
our,
we can
our bar
trust
is
the
here, not
now
here.
we can trust the information coming from the property, right? Where we were, you're almost cringing because you know they're either lying to you or they're just trying to paint the best picture of what's going on at the property, right? So we got a lot of transparency that's happening too, which is good because it allows us to make educated decisions on what we need to do.
It. And if we have a problem, we quickly, there's not 10 layers removed.
Yeah,
I mean,
picking up the phone,
quickly,
let's get it done.
Yeah. So let's see. Let's do 2 more questions. So Miles says, this is the high quality education bros, excellent. And P.S. I'm in a multifamily, Grant Cardone, et cetera. How do you guys agree with a 16-unit theory? Do you know a 16-unit theory?
I do not know a 16-unit theory.
I don't know what the 16-unit theory is. Let's see what the internet tells me. 16-unit theory. Let's see if I can get us an answer really quickly.
It's probably going to take way too much time to kind of figure that out. Miles, Ben at disruptequity.com, Ferris at disruptequity.com.
Just leaked my email to the world, man.
Sorry, buddy. This is what it's all about, right? So yeah, why don't you hit us up? Love to kind of chat and see what you're working on, and we'll try to answer that question for you offline.
Yeah, apologies. So let's see. So we would do one more question.
All right.
So let's see. We got a comment. Great content, guys. This is my first time joining, and I'll be joining future sessions for sure. Thanks. Chris, we'd love you to have you on. And if anyone has any more questions, let us know. Oh, and one other thing, we have a cheat sheet put together, disruptequity.com/MF cheat sheet. So go ahead and you can grab it there.
Yep. And this is just some stuff that we're putting together. We're trying to give best practices, folks, like we talked about earlier. We want people to do the business right, right? So this is not going to cost you any money. We're not selling anything.
Yeah. So Chris says,
just check it out.
Don't buy anything smaller than 16 units. That's what. Okay. I would go further. I'm going to create the Ferris 70-unit theory.
Yeah.
Don't buy anything less than 70 units. I mean, my first deal I almost bought was a 36 unit. I'm glad I didn't. Right.
No, that was a 32, right?
Sorry, 32, not 36.
Yeah, I remember that deal.
32 unit. And didn't do it. And we have a 90 unit where one staff wise it makes sense. You could probably get away with up to 70 units, 75 units, but
depends on where rents are.
Yeah, and I'll give you an example. We're managing a deal that's a 50 unit and a 30. You have to kind of start to get really creative with staffing.
Yeah.
And it's not necessarily the most cost effective way. So ideally, if you can, try to do 70 unit and above, right?
Yeah.
I mean, anything, 16 definitely becomes a problem because then you're also with 16 units, you're in a weird spot. Is it like a residential property management company or is it a commercial? Most commercial aren't going to touch it. Most residential don't know what to do with it.
Yeah,
so
you're going to be in that weird gray area, right? Whereas 70 and above, you will get legit third-party property management companies that will touch that, right? Especially if the revenue is high enough, because they all base their fees on revenue, folks. So just so you know, and that's it's not that we wouldn't buy a smaller one. It's not that. It's just going to be more property management intensive to do something like that, right?
Yep.
All right. What else we got?
So let's see. We'll do one more question, guys. For those of you tuning in, Money Mondays, we do this every Monday, 3:30 Central. Today's topic was talking about deal structures and fees. People should understand the structures and fees that they're committing to. And so we do a bunch of different topics. If you have ideas for future topics, let us know.
Please.
Otherwise, we'll pick something. And again, the best part is Q&A at the end. So let's see. So we're going through Q&A right now. We were already a little bit over time. But let's see. Mike says, yes, I heard Grant Cardone say that. Actually, my question was about the 32-unit rule. 70 units is huge. Yeah, I mean, honestly, it's buying a 7-unit and a 32-unit is not that much difference. It's just a little bit more equity, and I know that's where people get nervous.
They get jammed up, right?
Find other people. Real estate is a relationship business. That's why we're doing this. That's why we do anything we do. It's all about knowing people, building up your partnership, building out your network, finding people that are like-minded and trusted.
And where can you network?
And so where can you network? You can network, Zoom these days, but
MFM,
conferences,
buddy.
Multifamily Masters, we're a group we're part of, so go join the multifamilymasters.com Facebook group's a good example. Do national meetups across the country on that as well.
Yep.
We have a conference that we host. The next one will be sometime February.
Hopefully.
Kind of COVID. We'll see what happens there.
Yep.
But it's definitely critical. So if it's a deal, there are people that will happy to partner with you to help get that deal done.
All right, cool, man. This one was pretty popular.
Yeah. So let's just go ahead and call it a wrap.
All right. Well, thanks for tuning in, everybody. Catch us next week.
Thank you all. Glad to have you guys on. And again, Money Mondays, 3:30 Central. We will see you again next Monday. What's our topic, Ben? He doesn't know. That's why I'm asking him.
What's coming up? The ins and outs of
it's on here. You're lucky.
Real estate investing.
So the ins and outs of passive real estate investing.
Try to trip me up, buddy.
Ben got lucky. I like to. So Ben, how do you calculate IRR?
I got a smart partner. He usually does all those calculations for me.
All right. Well, we'll call it a wrap. So thank you guys.